Hello and welcome to the week ahead with me, Fiona Cincotta, Senior Market Analyst at City Index. Here we're just going to be taking a quick look at the main trade events which could influence the financial markets across next week, look at the assets and markets which will be or could be affected, and perhaps some trade setup ideas as well. So without further ado, I will just ask you to read the risk warning. I'm just going to pop myself on mute for a few moments where you can take your time to read through the risk warning. Okay, brilliant. So we will crack straight on. As always, if you do have any questions, then please pop them into the question box and I will address them as we go through the webinar. What we'll do is we will start with a look at the economic calendar. This is on our website, and basically I just filter this so that it is for the high impacting events for next week, and we'll just work through these, having a look at what is going on. So first up, on Sunday evening, we've got the GDP data for Japan. Just to let you know, I mean, this is, yeah, as I said, it's on Sunday evening. It's going to be a really interesting one to watch, this one. And that's basically because, and I'm just going to show you here the, let's just get this up here. Here we go. This is Japan's GDP. This is the previous reading that we had for the fourth quarter suggested that the Japanese economy fell into recession. Now we are actually expecting a upward revision to this reading. So that would mean that that Japan will have avoided a recession at the end of 2023. It could also mean that Japan retakes its spot as the third largest economy, which it actually lost following this reading to Germany. But I think more importantly than that, if we do get this upward revision to Japanese GDP, then that's going to potentially give the Bank of Japan more confidence to end the negative interest rates that it currently has, and potentially pave the way for the first rate hike since 2007. Now, the Bank of Japan are going to be meeting but a bit later this month, so on March the 18th and 19th. But it's been quite interesting. I mean, I'm just going to pull up a chart now, the Japanese yen US dollar Japanese yen chart, because we've had some big moves in this week, you know, up for a really big move lower. We've seen, and this basically has come on expectations that the Bank of Japan could potentially hike interest rates this month. And that was following inflation data that we saw last week, where core inflation, earlier this week, where core inflation was stickier than expected, and it rose to 2.5%, up from 1.8%. But also there are some signs coming in that that wage growth, which is an area that Bank of Japan are watching very closely, could actually be growing as well. And the Bank of Japan have said on numerous occasions that they're looking for that sort of wage inflation cycle. And while Bank of Japan's Governor Ueda has said that, you know, they would like to see more evidence, it also sort of hinted that there could be a move sooner rather than later. Also, we've had a major union in Japan agree higher wages for its union members, which again points to, you know, this inflation wage cycle that the the Bank of spiral that the Bank of Japan is looking for in order to cut rates, to hike rates, sorry. So at the same time that we're seeing that, we've also got this movement in the US dollar, which is weakening on expectations that the Federal Reserve could cut interest rates sooner rather than later. We'll come back to that in a bit. But as a result, we've seen these big moves in the US dollar, Japanese yen. So just having a look at the chart here, we can see that there was this resistance here around the 150.90 level that it just couldn't get above. You know, that was the 2024 high. And then we've had this really steep fall lower this week. It's taken out some pretty key levels here. It's taken out the 148.80, which was the January high. It's also breaking below the 100 SMA there at 147.80. And we're finding a little bit of support here around the 147 level. This is where it seems to be holding steady. If we just have a look, this is also a swing low there on the 21st of November. And also a swing low on the 3rd of October. So it's actually quite a key level as well. If we do get a breakthrough this, that it's going to expose the 200 SMA at around the 146 level. So I think, you know, if we do get an upward revision and a stronger than expected GDP data for Japan, then we could be looking at a further move lower in this trade at the start of next week. As far as any recovery is concerned, let's not forget we've still got the US non-farm payrolls to come out later today. But you know, as far as the recovery is concerned, buyers are going to be looking for a move over 100 SMA, which is around that 147.80 level, in order to retake this level here at the 148.80. And then sort of look towards 150, the psychological level. So let's crack on with what else we'll be watching next week. So we've been a bit starved of UK data recently. Obviously, we did have the Chancellor's budget this week. Well, it has boosted the pound a little bit. I mean, it was a relatively tame budget as far as budget goes. Everything was pre-trailed. There were no massive surprises. Obviously, there was that tax cut that we saw in the national insurance, but then the fiscal drag on the income tax threshold probably just about balances that out. So net effect, probably not going to be a huge amount of difference in our pockets. But looking ahead to next week, the focus is going to be on the UK labour market. The UK labour market has been holding up pretty well. This is the unemployment rate. If we can see, it's expected to hold steady. Oh gosh, just let me double check where it's supposed to be holding steady at. Unemployment rate 3.8%. That's where we're expecting to see it hold steady. As I said, I mean, if we look on historical terms, actually, unemployment is at historically low levels. So we're still seeing this relatively tight labour market. Obviously, a tight labour market does mean that sort of, you know, wage growth remains a pressure on inflation. And that's something that the Bank of England is going to be keeping an eye on. We know that the Bank of England, I think, are going to be one of the later major central banks to start cutting interest rates. Just because, I mean, we're still seeing inflation around that 4% level. Obviously, the Chancellor did say that he thought that, or the OBR, should I say, said that they saw inflation dropping to 2% by April. So that's not too far away. But the fact that they didn't mention anything about what happens to inflation after that makes me question that maybe it's going to reaccelerate again. But even so, I mean, you know, as far as the labour market data is concerned, the Bank of England will probably want to see some weakening, some moderating in strength of the UK labour market before it really starts cutting interest rates, just to see that wage growth, which, you know, did reach record highs earlier this year, will start to cool and put less pressure on inflation. So that's going to be something to watch, and especially given that the UK economy as well seems to be starting 2024 on the front foot after tipping into a recession at the end of last year. You know, data this year so far, so particularly the services PMI, has been encouraging. So yeah, I mean, you know, as I said, the Bank of England does need to see perhaps a little bit of moderation in the strength of wage growth, particularly before it really considers cutting interest rates. And so if we just have a look at what this means for the pound has had, again, a really solid week. It's risen really quite well every day this week, basically. And that, again, is a story as well of US dollar weakness. But we've seen the pound also be well supported on expectations that it'll probably be one of the last central banks, major central banks out of the Fed, the ECB and the BOE to cut rates. As far as the price action is concerned, so it was trading within this symmetrical triangle. It has broken out just at the end of last week, and it's now testing that 128.30 level. That was the high that we saw in late December. The price has actually risen above it. It rose to the highest level since July last year at 128.40. But I mean, I think what we'll be looking for here is a close above 128.30 to really be able to book a next leg higher towards that 130 level. As far as support is concerned, if we do sort of see a rejection at this level, then around the 127, we've got this falling trend line, which dates back to July last year. And then beyond that, we've got the 200 SMA, sorry, no, probably around 126. But also then you've got the 200 SMA at 125.80. So as far as what to expect from the data, you know, if we see a stronger than expected UK jobs report, then that's probably going to give the pound some extra strength to push higher. Like I said, obviously we've got US non-farm payroll reports, and they do have a tendency, or they can move the market. So obviously that's going to be something to bear in mind if you're watching this at the start of next week. So back to the economic calendar. What else we got going on? There is, you see, there's this mention here of German inflation, but actually that's the final reading. So it doesn't tend to be as market moving as a preliminary reading. We're expecting it to confirm the 2.7% reading. Whilst we're here, I mean, let's just have a look at the DAX, because I think it is worth taking a peek at what's going on there. The German DAX rose to record highs. We can see, and this is basically because we're seeing inflation cooling, we're seeing the economy cool. We obviously had the ECB meeting this week, whereby the ECB left interest rates on hold at the record levels of 4%, but they also downwardly revised growth and inflation forecasts, and Christine Lagarde pretty much signaled that June was a good date to start cutting interest rates should inflation continue to trend lower. So that news sent the DAX to record highs. Obviously, this was also supported by Jerome Powell's comments, which pointed to the Federal Reserve also cutting interest rates potentially sooner rather than later as well. And so, yeah, I mean, buyers on the DAX are going to be looking to get to that 18,000 level. Beyond that, you've got the upper band of the rising trend line. But just be wary, we've got it in overbought territory still, even though it's just consolidating a little bit today, it's still in overbought territory here. On the downside, be looking at support around the 17,680 level, or which was the previous high. Also 17,600, that's this week's low. So that's going to be a level that sellers are going to need to take out in order to create some sort of lower low. And that's going to then bring into focus the rising trend line here at around the 17,350 level. So, and then we move on. The rest of the calendar is pretty much focused on the US. So we've got big data coming out of the US next week with inflation. That's going to be the main focus. Expectations are for a slight cooling in inflation. More on that in a second. And then we've got retail sales, which fell in January. They are expected to pick up slightly in February. And then finally, we've also got Michigan confidence sentiment, which is expected to come through at 76.9. So, I mean, we're seeing an improvement in economic sentiment, but as I said, the main focus is going to be on the consumer price index, CPI, which came in last time at 3.1%. The data comes ahead of the Federal Reserve meeting on March the 20th. Just going to give you a quick look at this chart, which I think is really interesting. This is data from the Cleveland Fed Nowcast, and this is their estimate for US inflation. As you can see, estimated at the moment to come in roughly in line with where it is right now at 3.1%. Now, I mean, we've had Federal Reserve Chair Jerome Powell very much in focus this week as he's testified before the Congress. And I mean, what we've learned is basically the Federal Reserve has been pretty pleased with the progress that inflation has cooled so far. And interestingly, his comments from Powell have said that rate cuts could be close if inflation continues to fall. And I think going into his meeting this week, the big focus was on when will the Fed cut rates and by what scale. So, you know, it does appear that he potentially answered one of those questions saying that it could be soon. That's got the market believing that a rate cut is on the cards for June. But looking ahead to the inflation data next week, now I don't think it doesn't look like it's going to offer that rock solid evidence that inflation is cooling that the market might necessarily be looking for. So, you know, we've seen a big drop off in the US dollar. As you can see on this chart, this is the dollar index. We've seen a big fall in the US dollar. It's set to fall around 1% this week on expectations that the Federal Reserve will start cutting soon. What we do know is that the Fed is broadly sort of signaled that the broadly favorable trend in cooling inflation will cause it to cut in early summer. So, you know, I think there is this concern that this last little bit of getting inflation from 3.1% where it is now to the 2% target level is going to be quite a hard graph. However, we've also heard Federal Reserve Chair Powell saying that the rate of inflation doesn't need to fall to 2% before the US central bank is prepared to cut. Anyway, if we get a weaker than expected inflation reading, then we can expect to see the US dollar continue to fall towards the next target level, which is around that 102 level. It's just broken through that support 103, which is a pretty key level. I mean, it's offered both support and resistance at several stages across the past year. Any recovery would need to get back over that 103 level. That would then expose the 103.70, the 200 SMA, which would be the next step higher in order to bring the 2024 high of 105 back into focus. So we're just going to stick with US markets now, taking a look. We'll just have a look at what's been going on with the euro US dollar, how that dollar weakness has impacted the pair. As we can see again, yeah, it's really been quite a steep rally up here across the past month or so. Yeah, going back to well, mid-Feb. So yeah, over the last month, we've seen it break above the 200 SMA, and it's really powered higher, taking out that level there of the 109.30. That was the late January high. Buyers are going to be looking for a push towards the 110 psychological level. In order to do that, they're going to need to see that the US economy is potentially weaker jobs in today's non-farm payroll, and then also cooler than expected inflation. If we see that inflation reading come in hotter than expected, that might just cause the market to have just some doubts about how quickly the Federal Reserve will be cutting rates, and we could see a potential sort of stabilizing of the euro US dollar around that level, if not a slight fall lower. Next one to be looking at, should we have a look at gold? I mean, we can't not look at gold after its performance this week, can we? I mean, look at that, phenomenal, up at all-time highs, aggressively broke over the 21 sort of 50 previous all-time high, an absolutely stunning rally there. It's still, despite being extremely oversold, there's no desperately obvious signs in the candles of a reversal, but as I said, you know, I would be very cautious entering at these levels given the overbought RSI, which can signal a pullback or at least a consolidation at these levels. So yeah, just as far as where to look at, I guess sort of around the 21.90 level, which is the rising trend line. That trend line dates back all the way to November. Let's see if we can put it up here. All the way back to November 22. So that's a very long trend line that's been respected on several occasions across the years. So that would be an area that I would be looking at. Obviously on the downside, and then 2000. I mean, why not? Sorry, 2200. On the downside, support is going to be at the previous high, their all-time high of 2150. Below that, there isn't a whole load to be going from. I mean, around here, around the 2085 level, that was the December high, and that could also offer some support ahead of sort of the typical 2050 level here. But again, this is going to be very much dependent. If we do see inflation cooling and the market's happy with the level of cooling, then that's going to potentially fuel expectations of a June rate cut, which is going to help gold potentially move higher. Any sense that inflation is looking very sticky and raising concerns, that's when we're going to see potentially a rebound in the US dollar and a move lower in gold. What's the next one up? Next one up we'll be looking at is the Dow Jones, okay? So it's an interesting one, the Dow Jones, because it broke up to that all-time high at the end of February at 39,284, but actually it hasn't managed to do much more. It's slipped lower, it's fallen below that falling trend line. We've seen this consolidation. There is some support that's sort of being held here about the 38,450 level. That's the weekly low. That's the level that sellers are going to need to take out in order to create a move lower towards the 38,000 level. Interestingly, watching out for this RSI divergence that was going on, which did suggest that perhaps that was going to be the end of the run higher for the time being for the Dow Jones. Buyers, as I said, you know, they're going to need to look to take back that 39,280 level, which is also the rising trend line resistance, in order to book fresh all-time highs and head towards that 40,000 level. Final one to be looking at, there's not really much news going on as far as oil is concerned. I think it's very much been the focus has been very much on gold and Bitcoin, and they've sort of, risen to all-time highs, and it just means that oil has been a little bit off the radar. But it has been steadily grinding higher. We've seen it push above the 200 SMA now, which is around this level here, 70, just below 78. It's struggling though to push meaningfully above that 80 level. We did have a couple of pushes higher, but what we've got going on here, basically OPEC Plus have extended the oil output cuts of 2.2 million barrels per day, extended to the second quarter, across the second quarter of 2024. These are voluntary cuts, so I mean, the market, they are offering support to the market, but we haven't seen tremendous moves, well, since they were last bought in. But I suppose actually they were bought in around November time last year, and actually we have seen sort of a move higher on those extension of those cuts. The other side of things, we've got oil being supported by expectations that the major central banks will start cutting interest rates sooner or soon-ish. That's obviously going to help the oil demand outlook and push oil prices higher. An area of concern potentially is China. We've had the Chinese National People's Congress this week, where we saw or heard that China is aiming for 5% growth again this year. What's been really interesting is that wasn't necessarily surprising, but the market, I think, was pretty disappointed with the lack of bazooka-sized stimulus to get that growth into an achievable area. So, I mean, there are doubts about whether China will be able to rise to that level of growth, given that Beijing hasn't really offered out that much stimulus in order to get that. China, obviously very related to oil prices, largest oil importer on the planet. So, any news and data from China which is supportive of a growing economy would help this the oil prices higher as well. But still, as I said, it seems pretty supported above the 200 SMA. Buyers going to look for a more meaningful move over 80 in order to then sort of test the level just below 82. As far as the support is concerned, you've got the 200 SMA around the 77.90. Below there, going to be looking at this level here around 75 to offer some support. So that is everything from me. I'm just going to have a look to see how we're doing for time. Absolutely spot on for time, which is good to see. There are no questions up there at the moment, but obviously if you do have any questions, then please do reach out to me on Twitter, for example, on at Fiona Cincotta, at Fiona City Index. Thank you very much for joining me, and have a great weekend, and I look forward to seeing you next week.